part 2 of our investing in commodities theme. If you missed last week's discussion, please log on to www.abndigital.com and look under videos for that part 1. Now, many investors fall in love with certain sectors. This by default means large weightings to their favorite shares or industries. Now, when it comes to commodities, what is the ideal weighting in a portfolio? Tonight, we'll be taking a look at the critical question regarding asset allocation and how this translates to commodities. Joining us to help us analyze this discussion and give us some more insight into investing in commodities, Professor Evan Gilbert, head of MitonOptimal Asset Consulting, and as per usual, Cobie Legrange, strategist at ClucasGray Investment Managers, Roland, Rousseau, equity strategist at ABSA Capital. Welcome to you all. Now, Cobie, just going to throw back to a graph that we looked at last week because it looked at the risk-reward relationship between a basket of commodities that, of course, MitonOptimal had put together relative to equities, relative to some ETFs. So just take us through that.
Yeah, and I think the important thing here is that Miton has gone to look at the kind of commodities that we consume as individuals rather than just precious metals or potentially, and that's often how we understand commodities. And this portfolio that they've actually put together is a portfolio that they call the MOCCI, and there you can see the risk-return scatter graph of this MOCCI. So on the x-axis you've got risk, which you can see over there, and then you've got returns on the y-axis that you can see over there. And you can see if you just backtested those commodities, you could kind of see the kind of risk that you're assuming, which is not trivial, but you certainly have picked up very, very decent returns relative to, say, for instance, gold, which sits down here from a risk perspective, but you haven't really generated the kind of returns out of gold alone, what you would have achieved out of potentially food and fuel and many of those other type of commodities.
So, of course, tonight we're going to be talking about the ideal weighting. But, Evan, just take us through the rolling one-year correlation that we have. Of course, this graph between resource stocks and commodity prices, because, in the past one might have said, okay, well, I want to get exposure to platinum, I might go for Anglo-American platinum, and you would have got burnt on that one potentially. So take us through the difference in investing between resource shares and commodities.
Yes, most investors tend to think about commodities in terms of resource stocks. I mean, obviously, given the importance of resource stocks on the JSE, it's not surprising, but we can do a lot better than that. First of all, they're not the same thing. That's extremely important, and that's what this graph represents. It looks at the correlations between the changes in the price of shares, the commodity, the resource stocks, and the actual underlying commodities, which you can invest in now through trading futures or ETFs if they're available in the underlying commodities. And what we can see is that the correlations between the share price and the underlying commodity is by nowhere near one, and it varies quite a lot over time. Now, what this means is that from an investment perspective, the commodity shares and the commodities themselves represent different assets. They are positively correlated on average, which you'll see with the dotted lines, at around 0.5, which implies a positive correlation, but certainly great opportunities from a diversification perspective. And if you think about it, it makes a lot of sense. And the example of Marikana does highlight this. Lonmin's share price in the aftermath of the Marikana massacre fell precipitously, not surprisingly. But at the same time, the platinum price went up because the investors were expecting a shortage in terms of supply. Mm-hmm. So that's just an example, but that highlights the differences between the underlying commodity, platinum, and the actual share itself, in this case, Lonmin. So by combining, or at least looking at the commodities themselves rather than the resources shares, we actually have another opportunity to diversify risk.
Mm-hmm.
Evan, we're talking about correlations here, but let's just quickly talk about volatilities. Now, we always think the rand is incredibly volatile and that commodity prices such as the gold price or the oil price are very volatile. But equity prices are probably have double the volatility of these asset classes or commodity prices that I've just mentioned. So from that aspect, you're probably underestimating the risk-return benefit that commodities will give you by being comfortable with equities, which actually are more volatile. Is that correct?
That's correct. Certainly equities, obviously you're never going to put all of your eggs into one basket. You're not going to buy just one share. So similarly with commodities, you shouldn't buy just one commodity, which unfortunately, by the way, I think most investors here have been doing in terms of the gold exposure. But be that as it may, yes, absolutely. At the level of the individual commodities or the individual shares, you've got significant volatility. Now, people tend to see that, or consider that commodities are incredibly volatile, and therefore they shouldn't touch them. They're going to get their fingers burnt. But I think as the initial analysis which Cobie went through in terms of the scatter plot, looking at the MOCI versus the equities, in fact, they're very similar levels of volatility. Of course, these are two portfolios. One is a market cap weighted combination of shares. The other one is our combination of these particular commodities. But from a volatility perspective on a portfolio level, they're actually quite similar. And yet in this particular period, they did offer a particular return enhancement. That's not always going to be the case. You are going to have times where commodity prices are going to come off, particularly in declining inflationary environments. We did a study of the 70s and the huge run-up in international inflation leading to the Volcker era with high interest rates, and of course the great moderation leading up to the 2008 period. And there the returns from equities were the return from commodities were very different. So commodities may not necessarily always give you that return enhancement, but they will certainly give you that diversification.
Mm-hmm. Let's talk about the optimal weighting for commodities in a portfolio, because Evan, there is Regulation 28 that we have to take into account because that limits the commodity exposure there. So talk to us about what that means in terms of your the limitation that it places on how much you can have exposure to commodities, and then we'll talk about the optimal. We'll take you through some graphs in terms of optimal diversification with regards to commodities.
Sure. Look, Samantha, Regulation 28 is a requirement for pension funds to diversify. It forces diversification. It doesn't allow pension funds to put all their eggs into one basket. So what it does is that it sets maximum limits on the amount that you can allocate to a particular asset class. And it's been recently revised. And one of the changes that was made was the allowance for an allocation to commodities. And it's diversified commodities, not just gold. And so that particular limit has currently been set to 10%. So the maximum for a pension fund to invest in this particular commodity class is 10%. Obviously, retail investors with their own money may choose to do something differently, but we would suggest, given the volatility of commodities, to not obviously put too much into that particular basket. Mm-hmm. I assume you're going to go through the analysis now?
Yeah. We've got a scatter plot there.
I mean, I think Evan put together some efficient portfolios that I think would be the envy of most quantitative analysts. Let's quickly take you through those and put your thinking cap on, because I think this will require you to think a little bit about portfolio construction.
Well, viewers always have their thinking caps on, we hope.
Absolutely. These are called efficient portfolios, and they're built around an efficient frontier. And in essence, what we're trying to do, or what Evan is trying to attempt doing, is by mitigating risk to its lowest point and by trying to enhance returns up to its highest point. And that's in essence what he's trying to do here. So he's got two portfolios which we call unconstrained. He's not constraining any of the asset class ever. Here's a resource-based portfolio, which is that MOCCI portfolio he spoke about earlier. Commodity. And then there's a second portfolio here, which is only local equities. And you could see the kind of risks that you're assuming, which is basically on this axis over here, for the kind of returns that you could be generating from those. And then he constrains those in the blue line. And where you can see the Regulation 28 component coming through there. So let's zone in on that blue line and just have a look at how the actual asset allocation to the various asset classes changes over time in order to actually get to those returns. And there you can see kind of the big asset classes that we would utilize in South Africa. You could read them off the screen. Right at the top you see the commodity-based portfolio, that MOCCI portfolio, and you can see that what Evan has done there, he said, look, we want to put 10% of the portfolio in there, which is Reg 28 compliant. And you can see how those actually change over time. As a matter of fact, what the maximum Sharpe ratio portfolio, and that is now the what we're talking, the best excess return for the risk that you're assuming, actually runs somewhere over here. A huge amount of local bond exposure, a little bit of international bond exposure, very little equities as a matter of fact, and then cash. I mean, Evan, one of the things that kind of come to mind here is that local bonds seem to have a huge weighting as far as this portfolio is concerned.
I think that highlights, one of the limitations of this type of analysis. It really is based on average returns for a particular period and the correlations of the returns for the asset classes in this analysis over that period. So I certainly wouldn't want to say this is the last word on commodity or at least portfolio construction. It's for a particular period, and it highlights the point that in this particular period, commodities certainly would have played a role across the board in terms of your portfolios, no matter what type of return you're targeting or risk that you're prepared to take on. But so the couple of points then that we want to make. Yes, local bonds in this particular period did extremely well, and over this period we had interest rates coming down, which obviously boosts the value of your bonds, and so yes, bonds did perform well. Also because of the correlation differences between the bond returns and the equity type returns, as well as the other components of your portfolio, yes, it would do well. So that explains why local bonds is that green space is so large in this particular period. But from a consumption, at least from commodities perspective, what we're trying to show here is to say that commodities can play a role across the board. And so from that perspective, 10% was the maximum allowed, and it actually hit that maximum pretty quickly. But as you went higher and higher up the the risk dimension, you would have to add more and more of equities to enhance the returns. If we unconstrained it and we took away that Regulation 28 constraint, you'd find that the commodities would dominate given its relatively good performance over this period. Again, that's not necessarily a sufficient basis for constructing your portfolios, because the results are only true for that particular period, and as we know, the future is never quite what it used to be.
Evan, I think what investors have to do here is choose the level of risk they want. So this is a very conservative portfolio. So Samantha, if anybody wants to say, I'm not happy with 5% volatility, which is very low and very conservative, I want to have a higher, you can read off here what your asset allocation should be, and you'd obviously have more or less in equities, not so much in bonds, because you don't want to have such a conservative portfolio in the long run.
But to wrap this up, physical commodity exposure has a very important place in one's asset allocation strategy.
Correct, absolutely.
Yeah. Evan, just to get your final view on that right now, I mean, is there a percentage in mind that one has to think about over certain times, certain periods of your lifetime, or how would you think about changing your weighting towards commodities over your lifetime?
Samantha, the question that you're asking has relevance in the sense of the way that you get your exposure to commodities. If you're looking at a passive bundle of commodities, then you would want to be careful that you don't commit to a certain level and stay with it. But if you had to commit to something and stay with it over the long term, then we believe that the 10% to Regulation 28 allows is as good as a starting point as any. We also would think that as the market develops in the space, as more managers become involved in managing commodity funds, not resources, equity funds, but direct commodity funds, you'll have more choice as an investor to find somebody who can play a role of picking the right commodities at the right time, and there's certainly a lot of space for that given the volatility within the commodity basket.
Yeah.
So if you're going to go passive, look at 10%. If you're going to, as the market develops, you may look at changing that allocation and possibly giving some to an active manager who can hopefully do better than this passive index.